The economy did not decline as much as it would be when interest rates bite. Interest rates have not yet bitten most companies and most individuals. Not yet.
In light of current macroeconomic conditions, how should investors be positioned? Let's discuss this with Milton Berg. He is a founder of Milton Berg Advisors, and he's had a long career working on Wall Street with various hedge funds and notable investors. Milton, welcome to the show. Honored to be hosting you today.
Nice to meet you, David.
Nice to meet you, Milton. Let's first talk about your investment thesis. What are the sectors, equities, I'm talking about the equity sectors that investors should be overweight or underweight right now? And then we'll segue into your economic outlook from here.
Well, in theory, I say it's only in theory, we should overweight the banks, overweight the small cap stocks, and underweight this SP 500 and the QQs and the big cap stock. The reason I say this is, in theory, is because we had a low in the banking sector. I think it was on May 4th, the low of the banking sector. The banking stocks declined nearly 60% from its highs last January. Last January being January of 2022. But you had signs of a panic low, a real sign of a panic low in March, April, and May. You saw gaps to the downside. You saw highest volume in 11 years in the banking stocks. You saw headline news suggesting that these regional banks are going to go under. So these indices on a technical basis, you know, we try to do on a market technical basis, these indices had a panic low with gaps to the downside with high volume and reversals to the upside. So it's both the small cap indices, which are way underperforming the big cap indices, and the bank stocks, which had the latest low of the bear market was in May, while the S&P bottomed last October, and the Russell bottomed a year ago June, and the Dow bottomed the year ago September, and last September, and the Nasdaq bottomed December. These stocks just bottomed now, and in the bottom of that panic, they're certainly undervalued. If you can make an assumption that these regional banks will remain in business, they're trading at 7 times earnings, they're certainly undervalued. They're undervalued on a fundamental basis, and they show signs of panic flows or reversal on a technical basis. And on the other sector of the market, I'm basically in a new bull market. I think the stocks, the semiconductor indices have gained nearly 60%. Even China, off its October low, gained somewhat over 50%. The GDX gold stocks gained over 50%, but it corrected since then. So I say theoretically, the undervalued sector that has maybe a nice technical bottom at this point would have to be the bank stocks, and the small cap issue. Now, even a day like today, the SP is basically unchanged, down 4 points, 0.1%, but the Russell, the SP 600, which are small caps, are 1% of the days. That's why I say inferior. Practically, however, I can't really say that's the case. In other words, I'm going to admit that I'm confused. Markets are confusing me. I usually have a very strong opinion, but I'm somewhat confused because technically the reality is there are potentially problems with the banks. If you look at the statistics of borrowing for the Federal Home Loan Board, you see, that the old borrowings by FDIC insured institutions from the Federal Home Bank System increased toward 94.7% year over year into March 31st. Now, the reason you see increased borrowings from the Federal Home Loan Bank or increased lending is because there are serious credit problems, and these banks would rather borrow from the FHLB than to borrow from the Fed. And this is sort of a tip-off to the crisis because we started seeing this big surge in borrowing. Now, I only have data through March 31st. The data is a little bit lagging. I want to see whether this continued into June 31st. If we continue, that means there are some regional banks that are still in trouble and are still borrowing from the FHLB. That's why I say, theoretically, you want to buy the banks. Fundamentally, it's possible that the crisis hasn't ended. Now, I can really give you some information to suggest that this time is different. Different meaning that even though they had a panic low and even though they had high volume and so on and so forth, even though they're undervalued, there's a reason to believe that the market as a whole will continue lower. And that is because historically, if you go back to the history of the regional banking stocks and the history of the S&P 500 and the Nasdaq, you basically find that they bottom at roughly basically on the same day. I'm going to get my charts in front of me to tell you exactly what I mean. For example, the KBW Bank Index, BKX Bank Index, bottomed at the exact lows in 2002, in October 2002, same day that the Nasdaq bottomed and the SP 100 bottomed. Same thing in 2008, the S&P and the banking stock bottomed, like I think it was March 6th or March 9th, 2009. It bottomed coincidentally. So too in 2011, when the European banking crisis, you found that the U.S. banking stock and the S&P 500 bottom in the same day. And then again in 2015, when you had a mini bear market down 16% in the S&P, then the banking sector down over 20%, but they also bottomed in the same day. And so too again in 2019, late 2018, when the S&P bottomed late December 24th, or right before Christmas. So to the banking stocks, and on March 23rd, 2020, after the COVID crisis, the broad banking and the broad stock index, the Nasdaq and the S&P 500 bottom on the same day as the banking index. Well, this time is different. Guess what? The S&P bottom declined from 25% into October 12th from bottom. The Nasdaq declined some 35% or so into December 28th in its bottom. But the banking index didn't make it low until May 4th. Something's very different, which suggests to me, A, either that the S&P 500 and the Nasdaq are going to come back down and make lower lows along with the banking index and the bottom simultaneously. That's one thing to say, or that the banking index, that sector itself is in a crisis, and that's why they didn't bottom along with the S&P 500. That's what I would say. I take it one step further. I don't want to just pontificate here, but I take it one step further and say that if there is a crisis in the banking index that's still unknown, the SVB was saved by the Fed, and these other marginal banks are saved by the Fed, but if there's a crisis ahead, it's highly unlikely that the Nasdaq superstars, like the technology stocks, the AI stocks, and so on, are going to continue higher, while the banking sector is going to continue lower. So that's why I say kind of a little difference, a little bit confusing. But on a pure technical fundamental basis, you did see the low in the banking stock down into May 4th with panic.
Right. Milton, why is it that the S&P 500 and the Nasdaq have risen this year while the Russell 2000 has been flat?
Well, people are asking that question. The clear answer is because there was 7 or so stocks in the S&P 500 that are true growth names like Tesla or like Microsoft or Apple Computer and Google and so on and so forth. And people need a place to put the money, and they're putting money in these growth stocks. Even though these growth stocks may appear to be overvalued, historically, a true growth stock is never overvalued. I mean, it should say it's never overvalued, but it's rarely overvalued. I mean, look at McDonald's, for example, when they said it was overvalued in 1974, and it's up so like 16% per annum since then, since the low of that bear market. So it's difficult to say. People like to put money into these true growth names. Now, maybe they're not true growth names. Maybe some of these stock growth will falter. But in a situation now with somewhat slow economy, and people are putting their money into these names. But I want to point out is that this is a very, very, very rare to see just 7 stocks in the S&P 500 taking all of the indices up, taking the market up. Historically, the S&P is rallying, and the Russell 2000 and the S&P small caps are not coupling that rally. Historically, ultimately, it's not the other stocks that catch up, not the small caps that catch up to the S&P. Just speed of catching down to the small stock, and basically it's a sign of a bear market. I mean, you saw that in 1974, when the market peaked in January of 1973. It was only the Nifty 50 that peaked, but most stocks in the S&P 500 and the small over-the-counter stocks didn't have Nasdaq in those days. The over-the-counter stocks were lagging. You saw that again, believe it or not, it popped in February of 2020, right through the COVID crisis. The S&P made a new high, and the Nasdaq made a new high, but the Russell 2000 and the banking index, as a matter of fact, did not make it new high. They made a high in 2019. So this is it's kind of how you see it. Not really very, very bullish for the market. We were bullish all year, by the way. We were bullish at the end of last year, saying there's going to be big earnings here, which we had. But we think there's some sort of a change of character in the market now. It's quite possible that what we look like a bull market, that may have just been an extended bear market rally, and it's possible to get back to the lows. But I say, I'm not pounding the table either way. We're really watching the market on a day-to-day basis for the clues. And currently, the clues the market giving us is that the S&P 500, the change of character should be headed lower. Should be headed maybe even significantly lower. After we don't like to project how much lower it's going to go. We just like to be right on the right side of the direction. For example, we believe the S&P will correct, it may correct 5, 7, 10%, or we be in the bear market down 20, 30%. We basically will remain short around our market until we see evidence of a low. We don't try to project how far the market will decline. We just want to know that we're marked in a declining low until it goes into a rallying low. That's how we generally recommend our clients, and generally how we trade.
And so you were bullish up until now, and that call has
we were bullish. We like the number on February 2nd. If you change character, and on February 2nd is the day the New York Stock Exchange had supply line peak, S&P 600 peaked, the Russell 2000 peaked, S&P mid caps peaked, So there was a change of character in that market because you saw panic into that top. There's some gaps in some indices into the top and immediate reversal. Now, the reality was that top has held from many markets. The February top has held from the Russell 2000. The February second top has held for the S&P mid caps, S&P small caps. It's certainly helped for the retail sector. Retail sector that's collapsed on a price weighted basis, not a price weighted, but an equal weighted basis, as opposed to a cap weighted basis, and it's collapsed since then. So February 2nd wasn't a change in character. Then we noted there was a bottom in March, a short-term bottom, which took the markets higher, but we still see another change in character now because I don't want to get too technical, but the action of the NASDAQ, the action of the S&P 500 on June 16th, and again on July 3rd, 4th, 5th, show signs of the top as opposed to signs of acceleration to the upside.
Well, when you're talking about change of character, are you talking about purely technicals, or are there some fundamentals you're referring to as well?
Well, fundamentals don't change very, very quickly. In other words, people seem to think that the market moves off fundamentals, but the reality is fundamentals change very slowly. And the market is very often confused, and the market is often rallying in the face of negative fundamentals. Sometimes it's justified because the fundamentals will turn positive later on. It can be a deep recession, it can be a deep depression, and the market can start rallying because the market's anticipating it will come out of it. So, no, I think that the fundamental basis, things haven't changed that dramatically because basically the Fed has been tightening since last March, April. I mean, last March, April, meaning 2022, there was tightening. And interest rates basically are way higher than they were 2-3 years ago. So on a fundamental basis, the things that caused bear markets are still in place. You have a Federal Reserve tightening. You have the so-called quote-unquote inverted yield curve everybody's been talking about. And so I don't think the market changed that dramatically. It's a market perception that changed dramatically. A market, so I would say that what I see the change in character, the fundamentals may have been negative all along. It's just that the market was fighting it. Maybe the market was no longer fighting it. Or maybe, it's a straw that broke the camel's back. Maybe when they raise rates 1 time, 2 times, 4 times, 6 times, 9 times is not enough to break the economy, break the market. Maybe there's less push in the economy in July. Maybe that's big enough to break the economy. Maybe the market's anticipating that. But we do know that on June 16th, you had a panic, you had gaps into the S&P 500. On July 3rd, you had gaps into the NASDAQ and the X and so on. And then they reversed to the downside. Plus, you know that the D-line peaked way back in February, and the Russell peaked way back in February. And that's not a sign of a healthy market. So the fact that the S&P 500 is rallying looks great, but the fact that it's rallying on its own with the rest of the market flat is not a healthy sign at all. It's never been a healthy sign in the past. I said in the past, it's the S&P which comes back down to where the market is, as opposed to the rest of the market rallying back up to match the S&P. That's how historically.
It is interesting. Typically, when we think about tightening Fed and perhaps inverted yield curve, which we've had for almost a year now, Milton, we think the growth stocks will suffer the most. But in fact, this year, like you pointed out, 7 or 8 of the top growth stocks have led the index. Why is it that these growth stocks have performed well in despite the tightening monetary conditions that you've mentioned?
Okay. I will go back a little bit of market history to answer this question. We all know there was a devastating bear market in the U.S. from 1929 to 1932, where the market lost 80, 90%. So many companies were bankrupt, but the indices went down 90% or so. And then the market had declined to 1932. And that's sort of a weak rally, almost a nice rally from 1932 to 1937. But the averages were not really reflecting what was going on, because there's one famous stock called International Business Machines, IBM. Those days had a different name. That was taken out of the Dow in 1929 for some reason, because they felt that no longer growth stock. It turned to be raising growth. If you would have had the IBM and the Dow during that period of depression, you wouldn't have seen a 90% decline. You wouldn't have seen the rally also 32 was a little bit much greater. There was the glamorous stocks of the 20s, RCA, General Motors, actually crashed into the depression. It didn't do so well, but IBM, which was taken out of the Dow, did very, very well. What I'm pointing out is even in a great bear market, if you have a great company with great earnings and great potential, that could hold up even in a bear market. And that's what people are saying is taking place with Tesla. They're saying it's taking place with Apple. They're saying it's taking place with Google. They're taking place with Amazon. I don't buy it. I don't think Tesla is immune to a declining economy. I don't think Apple's immune to a declining economy. I don't think any of these stocks are really immune to a declining economy. It's just that The economy really hasn't started declining yet. If we're going to get a decline, which the market maybe started anticipating last year, but maybe this peak right here is going to start anticipating the next decline. Maybe in the next decline, these stocks will come down. Why these stocks move up now? Basically, they're not doing as well as we've done in the past. And everybody owns an iPhone, everybody owns a PC. They're not as if there's so much new growth coming, and to try to find the markets. But again, there's a liquidity buildup by the Fed for over a decade, and that liquidity has found its way into assets, and it's found its way into into these growth stocks beginning December 28th into roughly June 16th or July 3rd. But maybe it's a short-term where it's going to end. So you can say, yes, why did it happen? Because people are buying the stocks. Why are they buying the stocks? These companies showing earnings, and we think the companies have more resiliency than the other companies. But if there'll be economic downturn, I don't see why the stock will be safe. I really don't think they will be safe.
Let's talk about that for a minute. So you think that some of these companies have done well because of the perceived strength of these company fundamentals. Which do you think are a better reflection of the real economy, Milton? The mid-cap stocks, the Russell 2000, or the growth stocks, the FANG stocks, and the tech stocks that you just talked about?
Okay. Apple Computer is a great company because they have the iPhone. But ultimately, people are going to buy the iPhone if they can afford the iPhone, and companies are going to advertise with the iPhone if they can afford to advertise or the market conditions are good. Apple is dependent on the rest of the economy for the success. But Tesla is also dependent on the rest of the economy for the success. In other words, Tesla may be relative to General Motors, relative to Mercedes-Benz, relative to Chrysler, relative to Toyota. They can do very, very well and gain market share. But they're not going to do relative to economy when the economy is declining. So I don't think that there's really any of these growth stocks that are immune to an economic decline. Now, we haven't had the economic decline yet. You see, because there's still liquidity in the system that the Fed hasn't drained yet. But the Fed is doing, the QT, they're doing quantitative tightening, they're doing a pretty good job of tightening. They didn't raise interest rates as dramatic as they should have, considering the inflation rate. They certainly have been draining liquidity on the money supply to the extent that they should. They're really very aggressive about that. And these things lag. They just started this a little over a year ago, and there's no clear-cut rule as to how long it takes for monetary policy to have an effect on the economy or on markets. It had an immediate effect on the market because you had a bear market that ended in October, seems to make it October, but they didn't yet have a major effect on the economy. You had the quarterly growth of negative GDP growth. Did have that, but it was very, very mild. And earnings were still holding up somewhat, and jobs, unemployment was holding up. Employment was holding up, but in effect, if the market now change of track is anticipating a decline in the economy, I don't think any of these sectors will be immune at all.
So if I were to make the statement, Milton, that let's just take Tesla, for example, the Tesla stock more than doubled year to date, that's actually reflective of growth in the real economy as it actually reflects consumer sentiment and rising wealth over the past year or so. Would you agree or disagree with that statement?
Well, I would say the following. Tesla was a very oversold stock. Late last year, there was a lot of taxable selling, restrict the market down in general. Let's just look at Tesla for a minute. Let's just look at Tesla. I want to get some idea when we talk about the 100% gain in Tesla. Let me just get this Tesla. Okay, look at Tesla. Look at the chart. Tesla. Very nice, 100% gain, but the reality at today's price, Tesla is down 34.87% of its all-time high. So in reality, I can easily make a case that it's 100% rally in Tesla, the rally in the bear market. The reality is, we make it even stronger. Tesla's high on July 5th, roughly 282. The lowest price level on September 19th of 2022, 309. So guess what? This 100% rally may just be a what's it called? A retracement. It may just be they call it a dead cat bounce. It looks like a dead cat bounce because it's 100%, but relative to the decline it's at, you got to expect, even in their market, stock market rally. I want to point something out about the banking index because that's a nice volatile index. During the great banking crisis of 2007, 2008, the BKX, which is regional bank index, had a 70% rally lasting 2 months from July, I think it was like August and September, from July to September of 2008, rallied 70%. That's a banking index. So for one stock to rally 100% over a 2, 3, 4, 6 month period in a long-term bear market doesn't really not significant. I don't think it really means much. If you tell me it rallied to all-time highs in a breakout fashion, but if you look at the chart, it peaked in December or January of 2021, 22, made a lower high in January, a lower high in March, a lower high in September, and it's making a lower high now. So I don't see anything technical or even fundamentally about that. Tesla's margins are decreasing. Tesla's, not as if Tesla's making it, the earning growth rate they've had in the past, they're just happening, they're not taking market share because they definitely have a better product than Ford has. They definitely have a better product than General Motors has. I think the only competitor that I see is Kia. Kia has a very nice product. Other people are way behind the curve. So I would say that, no, Tesla's rallying is meaningless. And let's put it this way. If you have to wake up and we're heading an economic decline and the stock market down 30% from where it is today, I think Tesla will be down far more than 30%. And no one will be surprised about that. No one will say, how could Tesla decline 30% and it was up 100% in the first quarter of last year? Well, the first half of last year is really not a question. Markets fluctuate. And people, markets make mistakes and markets anticipate. Maybe the market anticipated the Fed won't tighten, the Fed will continue to tighten. We don't even look at tighten. We don't know what the Fed's going to do. We really do the best we can with the information we have. I don't think the fact that Tesla's around 100% is significant at all to tell you what the future market of Tesla will be. I don't think it helps at all.
Let's talk about the economy now. You mentioned several times that you don't think the economic decline has happened yet. Why do you say that?
Well, you did have too wide a decline to GDP, but usually economic decline shows up in the unemployment rate. And the unemployment rate has been very, very sticky, which means that the company is still hiring. Also, you have to realize one thing, and this is people, when you have years and years of zero interest rates, now people say, no, I never had zero interest rates in the United States, and you did on a real basis. Take the interest rate of a long bond relative to inflation or the T-bill, the short-term interest rates, the 1-year note, the 2-year note relative to the inflation rate. You had the negative interest rates for years and years, not just in the United States, in the rest of the world. Now, then, not every company in the world borrowed on a short-term basis. Many companies did borrow for 5 years, 10 years, 15 years. They locked in amazing rates, like, many mortgage people did mortgages at 3% or below, and they've locked in it for 30 years, and they're sitting pretty with the low interest rate, and while people have to buy a new home are paying higher rates. So not any company is going to be affected by the rise in interest rates immediately. It's going to take time. There's going to be a lag. This lag might be much longer than usual because, again, many companies are sitting with very low interest rates once they have to roll. Now, the United States government is kind of cuckoo because they've been borrowing short term. They should borrow when the interest rates were 1% at the 1.5%. They should have borrowed long term. They should have issued 100-year bonds, but they didn't do that. So the United States Treasury is going to be in trouble as rates move up. They're probably in trouble already. So therefore, I'd say why the economy did not decline as much as it would be when interest rates bite. Interest rates have not yet bitten most companies and most individuals. Not yet.
The unemployment rate has actually come down since the last reading. Now, or the reading before that, actually. If I were to make the statement, the unemployment rate. Yeah. So if I were to make the statement that the unemployment is low right now because it's a lagging indicator, and actually people are already getting laid off as we speak, and the labor market is not very strong as we speak, would that be an accurate statement to make, Milton?
I think yes. I think it's like when you turn a large boat. It turns very slowly, and you don't even perceive it initially. So yes, I think that a chart in the employment may be here. It doesn't show the statistics immediately, and it's not significant. You're gonna go from 3% unemployment, 3.5% unemployment to 8% unemployment. It's not going to accelerate it's going to slowly turn from 3 to 3.5 to 3.75, and then it's going to accelerate as a recession. As a recession deepens. So we don't really know if there'll be a recession. Economists have a lot of difficulty in predicting recession, and certainly market analysts have very difficulty in predicting recession. We just try to predict market movements and project market movements based on market action. And listen, Tesla had a nice run up, but it's still 35% below its highs. It's a nice bear market rally. If you're in a bear market, or if you want to call it a bull market, call it grade 161%, call it a bull market. But if it declines again, the chart will be a perfect chart for bear market. Lower highs in last January, lower highs last March, lower highs in September, and then a lower high right here in July, lower in September high. It's very strange that their highs it tested below September high Yet people are getting very positive about Tesla.
I've been hearing from a lot of economists that a recession is coming. Let me just offer one counter argument to that, and perhaps you can challenge this if you like. So a lot of the slowdowns that we're seeing in sectors such as real estate, construction, these slowdowns are really just relative to the pandemic highs that the economy has. And so it's really because of a high base effect that we're seeing a normalization of growth. It's not that we're heading towards negative growth. It's just that things are normalizing. Certainly, if you take a look at something like the lumber price, for example, yes, it's crashed from the 80% from its all-time highs, but it's really just trading at near pre-pandemic levels. So how would you respond to the argument that things are slowing down because things were so overblown over the last 2 years and things are just normalizing right now? We're not really headed towards a recession.
That's quite possible, but really, it's not just the pandemic. It's the reaction to the pandemic. It's the fact that the Federal Reserve and central banks around the world basically liquefied the economy to such an extent we never saw in history, and that's been drained. So initially, I'd say it looks good initially. Initially it's Goldilocks, but the economy turns from higher liquidity to low liquidity. Initially, it looked very, very good, and the market looks good now. But if you're going to get to a drain in the economy, you're going to get to a drain in liquidity. You can get with companies that are going to be strapping to borrow money, then things will be very much more negative than they seem. So this is a good period at this point, but we really can't say they're just good now. The situation will continue at a continued level. And usually, economic booms end with economic busts. Usually, interest rate booms end with interest rate busts. If the Fed is serious about fighting inflation, they're not there yet. They want to get down to 2%. They really should get down to 0%, because truthfully, in history, the Federal Reserve was looking at 0% inflation. It's 2%, which is sort of a marvelous phenomenon. It started at 1%, when at 2%. Bernanke explained the 2% thing because he said it's just a question of being certain that you're not below zero because he's so afraid of deflation. But no one really wants 2% inflation. They really want 0%. They go to 2% because they're afraid they can't measure it at 0%. But anyway, yes, you're right. Things could look good, but generally, you don't just flatten out. Generally, you have to have a boom. You're going to have a bust, especially when the central banks throughout the world are tightening. So it can go either way. I'm not pounding the table either way. I just say right now, you got a nice rally of the market and the economy beginning last December and January. It's strange that the small company can peak back in February. Very, very strange. It just is a good economy. It's not so strange that the big caps continue to higher because there's still liquidity and people are chasing those stocks. But it wouldn't be strange to me if the bear market rally ends right here and we head much lower and the economy looks, as you say, looks flat, looks like it's doing fine just back towards pre-pandemic. Wouldn't surprise me if it gets start declining. And basically, once the short-term rates hit, the increasing rates hit the consumer, hit the corporations, that might be what causes an economic decline. Well, or even the decline of money supply. It's always been a lively indicator. The money supply has declined, and I believe that it may not yet have had its effect on the real economy.
I think investors are just, like you said earlier in the interview, confused as to how they should be positioned going into what may be a recession, maybe not. Again, there's some uncertainty around that. There's some uncertainty around how long this rally could last. We've had a very good year. People don't know how much longer this rally could last. Generally speaking, how should investors be positioned right now in light of all this uncertainty, Milton?
Well, if people who are not traders, people want to invest it, meaning that they put aside some money in the IRA or every month or so, every quarter or so. Then they really shouldn't be concerned about the market direction. They should just find a good company with good management and average down if the market goes down. People who are investors should understand that the best place to invest in an economy and in the stock market, in your own businesses, and the economy runs on business. The economy doesn't run on government. The economy doesn't run on debt. The economy runs on growing businesses. And you need to get your financial advisor yourself. Find a company that's doing very well. It doesn't matter whether it's a technology company or whether a food company or a grocery company or a oil company and so on. You find a company that's well, and you buy these stocks and you accumulate stock. No reason not to accumulate stock if you're a long-term investor. Then if you already have a lost portfolio, if you already built a portfolio over the years, or you're an institutional portfolio, you're an endowment, or your family often have lost portfolio, I think at this time, and we're traders, I think at this time you should lighten up. You have no business being in stocks after a stock like Tesla, 161% rally, which gave me a bear market rally, and the market showed a change of character by having shown panic into June 16th and a reversal after July 3rd. That's on a technical basis. If your viewers are mainly retail people who are accumulating stocks, don't be afraid to accumulate stocks in the bear market, because you're not going to need this money until you retire 20, 30 years from now. But keep buying a big company that, and as the market declines, we'll be getting better prices. We'll have to time the market. But you have a nest egg in a portfolio, you want to be very, very careful. I don't think now is the time to invest in stocks if you're, even if you're speculating, because I believe the market is showing signs of having top.
Right. So finally, Milton, I'll give you one potential risk to the buy and hold strategy. Take a look at Japan, for example. The bubble burst in the late 80s. Then the country went into a decade-long stagnation in the deflationary era that we saw throughout the 90s. The Nikkei never recovered to its post or pre-bubble high. So it's never gone back to the 1989 high. And actually, it took about 20 years to recover to its 1991 high. Did that happen to the United States?
David, that is exactly the argument I've always made to investors. I see people who talk about stocks for the long term. Even wrote books, economic affairs, I book stocks for the long term. Stocks for the long term. When you look at the history of stock markets, there's some great countries that have great stock markets and ultimately collapse. The Netherlands, for example, in the 16, 17, 1800s, they were the greatest stock market in the world, ultimately collapsed. If a country turns from capitalism to communism, then certainly the stock market would collapse. Look at Argentina, look at Venezuela. And you're right about it. That's why I say but someone in Japan who was accumulating stocks from 1989 till now, buying into the weakness, probably certainly didn't do as poorly as some of the institutional who was invested at the top of 1989. There were many 60, 70% rallies in Japan over this period. And there were many times to buy cheap stock. Let's look at the Nikkei, for example. The index go back to 1989 when it peaks in a second. But that's a great example. I always give that example as well. There's no reason to think that stocks will always do great for the long term. The Nikkei is below where it was in 1989. But the reality at this moment, this print, I'm looking at using quarterly prices. At this print, we are just currently, it's only 14% below where it was at its peak. And somebody, now, from 1998, we're talking about 30 years, basically. That someone who was putting aside money in an IRA in 1989 and just accumulated stocks every month or every quarter, the same dollar amount, every month, every quarter, as his salary went up, he put a little more, and he would do quite well if he picked nice, good stocks that were made in business, despite the fact that the Nikkei is down. However, as I say, many people have a portfolio, many institutions, endowments, they have definitely long-term investments. And I'm saying here, now is not the time to make a long-term investment in your stock market. And generally, when you have a portfolio, it's more difficult to invest than when you have just accumulating stocks. That's actually the reality. No, investing is not an easy game. There are many nuances and there are many difficulties. And people who just say, get out of stocks forever because we're headed for depression. You can say, must be in stocks forever because stocks are good for the long term. Generally, but it doesn't really work that way. So I'm sort of a little bit nuanced. If you're accumulating stocks for the long term, just keep accumulating, even the market will go down. However, if you have a nest egg or you have a portfolio that you have to invest, you got to get much more careful. And you can't just say Tesla is moving up and Apple will go up. You got to buy those stocks. It makes no sense.
Yeah, okay, let me just close on the thought, Milton. If you were to bet on either the stock markets performing the same way they did, the U.S. stock market, I'm talking about the U.S. now, the U.S. stock markets performing the same way that they did all throughout the 2000s, post-2008, or a stagnation over the next 10 years. I'm talking the next 10-year period. Which side would you be betting on?
But I bet a stagnation is one caveat. Stagnation will be in real terms, not in necessarily nominal terms. In many countries around the world, let's say the Weimar Republic, even let's just say even Venezuela, that have only stock market in local currencies, but in real terms, inflation adjusted, the stock market's collapsed. So yes, you can't look at the S&P 500 because the reality is, the S&P 500, I'll even tell you a reality. SPX, let's look at this. The S&P 500 is, people tell you, give me 1 second, people will tell you that at today's price, the S&P 500 has declined 8.17% of its high in 2022, January 2002, right? Got to add some 12% to that. It's actually down over 20% because on an inflation-adjusted basis, you're losing money. The S&P at 4401 today is not the same as S&P at 4401 2 years ago. So that's why I say, yes, probably on a nominal basis, you could see higher prices. It would seem that the stock market was rallying, but on a real basis, no. And the prime example that I give is the stock market from 1966 to 1982. On a nominal basis, I think it was only down to 20%. On a real basis, down to 80%. Was adjusted for inflation. So, but the answer to your question, in short, is stagflation rather than the kind of move you had after 2008.
Excellent. Milton, thank you very much for a very thorough interview. Where can we follow your work and learn more from your research?
Well, I have a website. I think it's called miltonberg.com, and there's a email for any information about our firm, info@miltonberg.com. But basically, look at the website. Any other thing you can just contact us. There'll be a book coming out, not late this year, maybe early next year, and we'll discuss a lot of the strategies we have in analyzing markets. Appreciate this interview. Thank you so much.
Thank you very much. And we'll speak to you next time. And thank you for watching. Speak again soon, and don't forget to subscribe.